There is a number circulating right now that is breaking people's brains in two different directions at the same time. $122.5 trillion. The bullish crowd grabbed it as proof that XRP is going to do something miraculous next quarter. The bearish crowd grabbed it as proof that the entire community has lost its grip on reality. And both of them are wrong because almost nobody bothered to ask the most important question. What does that number actually measure? The number one mistake retail investors make in this market is conflating two completely different concepts that sound the same but are not the same. They conflate the size of an opportunity with the valuation of an asset. They look at $1 trillion figure attached to XRP and they assume that figure is a price target. It is not. It has never been. And until you understand the difference between opportunity sizing and asset valuation, every viral headline you see is going to either thrill you or insult your intelligence, and neither response is going to make you any smarter about what is actually happening. What I'm about to walk you through is not being explained on the news, it is not being explained on the major XRP channels, and it is being completely buried under thumbnails of rocket ships and yellow arrows. Let me pull back the curtain on what the $122.5 trillion figure actually represents, why the bullish takes are accidentally right but for the wrong reasons, why the bearish takes are accidentally wrong but for the right reasons, and the single analytical move that converts a meaningless trillion-dollar headline into a real defensible thesis about how this asset gets repriced. The world misread the signal again. We are going to fix that today. Welcome back. I am the Calm Analyst, and on this channel, we do not chase price targets. We do not promise Lambos, and we do not sell you fantasy. We decode infrastructure. We read the filings. We follow the math. Today, we are going to take a viral trillion-dollar number, separate it from the noise around it, and rebuild the actual analytical framework underneath. By the end of this analysis, you will know how to read every future TAM figure attached to this asset without getting either overexcited or dismissive, because you will finally have the right mental model. Sit back. Let's get to work. Let's start with the hard truth. About 95% of the people sharing the $122.5 trillion figure cannot tell you what it actually measures. They saw it on a thumbnail. They saw it in a tweet. They saw it referenced casually in a video. And they treated it as if it were a price prediction or a market cap target. It is neither. It is something more interesting and more useful, but only if you understand what it is. To make this simple, you need to understand a concept most retail investors have never absorbed. There is a critical analytical distinction in finance between total addressable market and valuation. Total addressable market, TAM, is the total size of the opportunity surface a technology, asset, or company is positioned to interact with. It is the universe of possible flow. Valuation is the price the market assigns to a specific entity based on its expected share of that flow, the timeline over which that share is captured, and the structural mechanics of how that capture translates into unit value. These are not the same thing. They are not even similar things. One is a map, the other is a destination. And confusing them is the single most common mistake retail investors make. When someone says XRP is connected to a $122.5 trillion opportunity, what that figure is actually pointing to is the rough scale of global cross-border payment flow, the annual volume of value that moves between countries through banks, financial institutions, and payment networks. That is the opportunity surface. It is enormous. It is real. It is growing. And it is structurally inefficient in exactly the ways that XRP was engineered to address. None of that is in dispute by serious analysts. The dispute is over how much of that surface XRP actually captures on what timeline and what that capture implies for unit price. This is the analytical move that almost nobody on YouTube does correctly. They see the $1 trillion number, they reach for a calculator, they divide by circulating supply, and they produce a price prediction that is either fantasy or insulting depending on your priors. That math is structurally invalid, and I want to explain exactly why so you never make that mistake again. You see, when you divide TAM by token supply, you're implicitly assuming that the entire opportunity surface gets captured by the asset, that the entire captured value sits as static market cap inside the token, and that token velocity is zero. None of those assumptions are true. They have never been true for any real asset in any real financial system. They are not even approximately true, which means any calculation that starts with let's divide 122.5 trillion by 100 billion XRP is producing a number that has no analytical meaning. It is a fake number that emerges from the wrong math. The crowd is asking, if XRP captures $122.5 trillion, what's the price? The calm analyst is asking, what share does XRP capture? What is the velocity of that capture through the network? And what unit price does the resulting liquidity requirement imply? Those are not the same question. And only one of them survives contact with how settlement assets actually work. So let me walk you through how this analysis is actually supposed to be done. Because once you see it, you cannot unsee it, and every future viral headline becomes a lot less mysterious. Step 1. Start with the addressable surface. Global annual cross-border payment flow is approximately $150 trillion. The figure you see floating around in different references, $192.5 trillion, there are $150 trillion, hundreds of trillions when you include FX volume, depends on what specific subset of cross-border activity is being measured. Do not anchor on a specific decimal. Anchor on the order of magnitude. We are talking about flows in the 100 trillion plus range annually. That is the surface. That is the universe of possible activity. Step 2. Estimate the captured share. This is the assumption layer where reasonable analysts disagree and where most viral content silently substitutes 100% capture without telling you. A hyper-bullish capture assumption might be 5 to 10% of cross-border payment flow over a decade. A moderately bullish capture assumption might be 1 to 3%. A conservative capture assumption might be a fraction of 1%. None of these numbers is wrong. They are different scenarios with different probability weights. Your job as an investor is to pick the scenario you think is reasonable, not to assume the most aggressive one and call it analysis. Step 3. Apply the velocity correction. This is the part that almost no retail content covers, and it is the single most important concept in valuing a settlement asset. When XRP serves as a bridge currency for cross-border payment flow, it does not sit in someone's wallet for a year. It is acquired, used to clear a transaction, and released, sometimes within seconds. That means the same XRP token can support multiple transactions over the course of a single day. The amount of XRP that actually needs to be held to support a given annual flow is the flow divided by the velocity of the asset through the network. Higher velocity means you need less XRP held in liquidity pools to support the same volume of flow. Lower velocity means you need more. And here is the counterintuitive insight: higher unit prices for the asset also reduce the amount of XRP that needs to be held, because you can support the same dollar value of flow with fewer tokens at a higher price. This is the technical reason proponents of utility-based valuation argue that XRP's price needs to rise to support real-world settlement at scale. It is not a moonboy fantasy. It is the math of how liquidity scales in settlement networks. The price of the asset and the size of the liquidity pool are inversely related at fixed flow volume. Step 4. Translate liquidity demand into unit valuation. This is where the math gets specific to the asset's supply structure. Of the 100 billion XRP supply, the majority is locked in escrow with controlled monthly releases that are largely relocked. A meaningful fraction is held by long-term holders who have not moved their tokens in years. A growing portion is being absorbed into ETF wrappers, corporate treasuries, and stablecoin operating reserves. The actual tradable float, the float available to support active settlement liquidity, is a fraction of the headline supply. When you plug realistic capture, realistic velocity, and realistic float into the math, the resulting unit price band is wide but not infinite. Different assumption sets produce different numbers. Aggressive assumptions produce numbers in the 4-digit range. Moderate assumptions produce numbers in the high 2-digit to low 3-digit range. Conservative assumptions produce numbers meaningfully above current levels, but well below Moonboy fantasy. None of these numbers are guaranteed. All of them are defensible, given the assumption sets they emerge from. This is what real analysis looks like. It does not produce a single number with absolute certainty. It produces a range, conditional on assumptions, with explicit acknowledgement of which assumptions drive the result. Anything that gives you a single confident number with no error bars is not analysis. It is content. Now, I want to put a single piece of context in front of you that should reframe how you read every future TAM figure attached to XRP. The reason these massive numbers exist in the conversation at all is because the institutional infrastructure required to capture meaningful share of cross-border flow is actually being built in real time by real institutions with real capital. A 160-year-old French bank deployed a regulated euro stablecoin on the XRP ledger after evaluating Ethereum, Solana, and Stellar. South Korea ran its first real-time tokenized government bond settlement on Ripple custody. Japan demonstrated XRP cross-border settlement at roughly 60% lower cost than the legacy network with sub-4-second finality. Coinbase reclassified XRP into the same execution framework as Bitcoin, Ethereum, gold, and crude oil. Sovereign engagements are accumulating. ETF inflows are running at institutional scale. None of these are speculative. They are operational, they are happening, and every one of them, taken individually, would not justify a TAM-scale conversation. But stacked together, in the same window of time, they describe an asset that is in the process of crossing from the speculative tier into the settlement tier. And once an asset crosses that threshold, the relevant valuation model shifts. You stop pricing it like a crypto, you start pricing it like infrastructure. And infrastructure assets in finance derive their value from the scale of flow they enable, not from the speculative sentiment of retail traders. Ask yourself a brutal question. Does a multi-trillion-dollar institutional allocator look at this asset and think, will it 5x? Or does it think, if even a fraction of this infrastructure thesis materializes, what is the structural ceiling and what is the asymmetric position I should take while the price still reflects speculative tier valuation? The answer is obvious, and it tells you something important about why allocators are willing to do the legal work, take the headline risk, and build the custody relationships before the gate fully opens. They are not positioning for a moderate outcome. They are positioning for a structural revaluation, with full awareness that the timeline is uncertain and the path is not linear. Now let me be honest about the realistic timeline, because this is where bullish takes get reckless and bearish takes get lazy. A scenario where XRP captures even 3% of global cross-border flow does not happen in 18 months. It happens over a decade, possibly longer. Financial infrastructure does not get rebuilt on retail timeframes. It gets rebuilt on multi-decade institutional timeframes, with periodic step changes that look sudden in hindsight, but are actually the result of years of quiet preparation finally surfacing above the waterline. A more grounded interpretation of the $122.5 trillion figure is the following. The structural conditions required to capture meaningful share of that opportunity surface: full institutional integration, regulatory clarity, displacement of legacy rails, technical readiness, sovereign acceptance, represent the long-term ceiling of the XRP thesis, not the 18-month base case. If those conditions all materialize on the most optimistic timeline imaginable, the math produces price bands that today sound impossible. If they materialize on a realistic timeline, the same math produces a much lower number for any specific year, with the higher bands sliding into the back half of the decade or beyond. That is not a bearish read. That is a calibrated read. The thesis is intact. The math is intact. The timeline is what gets compressed in viral headlines and stretched in honest analysis. Both versions are looking at the same fundamental model. They are just choosing different points on the timeline curve. This isn't a prediction, it's a requirement of the math. If you want to clear meaningful share of global cross-border flow through a finite token whose tradable float is shrinking, the unit value of that token has to expand to absorb that flow without breaking the order book. That is not opinion. That is the operational physics of how settlement assets get repriced when their utility is recognized at scale. If you have a problem with these numbers, you do not have a problem with me. You have a problem with the laws of finance. Now I want you to think about what this means for accumulation, because this is where the practical implication actually lives. We are moving from an era of XRP abundance to an era of XRP scarcity, and most people will not realize the transition has happened until it is already over. Of the 100 billion fixed supply, the majority is locked in escrow with controlled monthly releases that are largely relocked. A meaningful fraction is held by long-term holders who have not moved their tokens in years. A growing portion is being absorbed into ETF wrappers, corporate treasury positions, stablecoin operating reserves, and institutional custody infrastructure. And exchange reserves, the float that is actually available for purchase, has been on a multi-year drawdown. Here is what nobody wants to say out loud. Once a token is committed to a regulated institutional infrastructure layer, it does not come back to the open market for a 10% profit. It is structurally embedded for years, sometimes for the entire cycle. Every infrastructure deployment, every ETF inflow day, every corporate treasury allocation is mechanically a permanent supply removal event. The float keeps shrinking, the infrastructure keeps building, the institutional pipeline keeps loading, and the spot price keeps doing what spot prices always do during these phases: chopping sideways, frustrating retail conviction, shaking out the impatient. The window for accumulating whole tokens at current prices is not infinite. It does not close on a specific date that I can give you. It closes when one of two things happens. Either the institutional capture rate accelerates faster than the order book can absorb at current levels, or the supply absorption simply outpaces the float that is willing to sell. Whichever happens first ends the window. The institutions, the central banks, the sovereign treasuries, the systemically important banks, they have spent years quietly preparing for the regulatory and infrastructure unlock. They have done the legal work. They have built the custody relationships. They have written the compliance playbooks. The retail crowd has spent those same years getting shaken out by CHOP, by FUD, by sideways months that feel like they will never end. That is not a coincidence. That is how every major asset reclassification in modern financial history has played out. The patient holders who understood the structural story end up on the right side of the revaluation. The impatient holders who treated this as a trade end up as the exit liquidity that funds the entry of the informed. I know it is hard to hold conviction when viral trillion-dollar headlines hit your timeline every week. The bullish ones make you greedy. The bearish ones make you scared. As an analyst, I am trained to distinguish between noise and signal, and I want to be honest with you about something. The $122.5 trillion figure is not the signal. The framework underneath it is the signal. The framework is sound. The capture rate is debatable. The timeline is uncertain. The output is sensitive to the inputs. That is what real analysis looks like. Anything that reduces this conversation to a single number with absolute certainty is not analysis. It is a thumbnail. Being early feels exactly like being wrong, right up until the moment reality catches up. The boredom you feel right now, the chop, the headlines that say crypto is dead again, the headlines that say XRP is going to capture all of global finance next quarter. Both of those are noise. The signal is the structural build-out happening underneath all of it. I cannot tell you what 1,000 XRP will be worth in 2028, in 2030, or in 2035. No honest analyst can. What I can tell you is that the infrastructure being built underneath this asset is consistent with a settlement tier valuation, not a speculative tier valuation. And the gap between those two tiers is exactly where the holders who paid attention get rewarded. Stack what you can responsibly afford. Plan around your real life, not around a fantasy. Do not borrow against a TAM figure. Do not make life decisions based on a number on a thumbnail. And distinguish between the noise of the day and the signal of the structure. Let me close with a single thought. The crowd is debating whether $122.5 trillion is real or hype. The calm analyst is watching the framework underneath that number quietly become the consensus model for how settlement assets get valued in the next decade of finance. One of those debates fits on a thumbnail. The other one fits inside the foundation of how the global financial system gets repriced. TAM figures are a distraction. Capture rates are the reality. One is a number, the other is a thesis. History does not reward comfort. It rewards the people who paid attention while the room was loud about the wrong thing. If you made it to the end of this analysis, drop the word capture in the comments. I want to see who actually understood what just got broken down today. Because that is the audience I am building this channel for. If this is the kind of breakdown you want more of, the kind that takes a viral headline, dismantles it, and rebuilds it into something honest, you know what to do with the subscribe button. In a market fueled by emotion and noise, we thrive on data and composure. Stay patient, stay rational. The math doesn't lie, and the system is almost complete. I am the calm analyst. I'll see you in the next briefing.